So we've got a rare episode of Stock Market Daily today. I know we haven't had one of those in a long time, but my oldest subscribers remember when I used to record my videos in the living room. The whole setup was a mess and we used to do these Stock Market Daily videos. Anyway, the reason we're doing it today is because some big news is out on Shopify stock and Johnson & Johnson stock. Both of them are down over 10% just today alone. Shopify has a secondary offering of new shares that they're putting out into the market. And then when looking at Johnson & Johnson, a report came out from Reuters saying that they've not only been supplying talc products like baby powder that were contaminated with asbestos, but that they may have even known about it as well. So that cannot be good news. Let's go ahead and get started. What's up, everybody? My name is Ale and welcome to my world of stocks and welcome to Stock Market Daily. So the major indices today are down about 2% or more when looking at the Dow, NASDAQ, and S&P 500. But when looking at Shopify specifically, if you don't know about Shopify, they're a Canadian-based company that is a direct play on the whole e-commerce movement. They basically help businesses, which are many times small businesses, and they help them set up an online shopping store. They help them with all sorts of services and many different tools. They help them with digital payments. They provide them with analytics so that they can become more successful in the e-commerce market. And it's really a great product that they're selling because many businesses still need to adapt to the online shopping revolution. In the US in particular, only around 10% of total retail is even done online. So it's a great market to be in with lots of growth opportunities. And that has sent the stock climbing for the last several years. In fact, in the past 5 years, Shopify is up over 400%. That's an enormous increase in their share price. However, the stock took a really big hit today, at one point dropping by over 13%. So what exactly happened? Well, they announced the pricing of their previously announced secondary offering of 2.6 million new Class A shares at $154 a piece. And they released them to, quote, strengthen their balance sheet and provide flexibility to fund growth strategies. However, the stock is now trading at about $140 per share, and this is coming off of another secondary offering that they did back in February that raised over $650 million. Ultimately, offering more shares is one way to raise funds for a company without having to take on additional debt, but this is already the second time that the company is doing it this year. And the other issue is that most of the time when you offer new shares, it's going to drag down your stock price because the market is aware of the fact that you're trying to sell more, so there's more selling going on. You also have more dilution, and it also ends up hurting your EPS numbers going forward. So all of that kind of accumulates and it drags down the stock price, which is what we're seeing today, down about 13%. Now, in their latest quarter, they did see revenue surge by over 50% year over year, which is very impressive. So I don't necessarily have a problem with a high growth company wanting to raise more funds to keep that growth moving forward, but their net loss also increased by over 100%, which isn't great. And even after adjusting their net income, it still decreased from around 5 million down to 4.5 million. And while I personally do think that this company has a very bright future, I'm not sure I can invest in them with a forward PE ratio of over 200. But again, I'm not saying that I'm not bullish on Shopify in the long term. I think they have a very bright future. They're already growing at a very fast rate, and it is definitely a stock that I track very closely, but I've never invested in them because, obviously their forward PE right now is very high. Like, they're still not technically profitable, but going forward, they're expected to be. So their forward PE is like over 200. They obviously don't pay a dividend. And the other issue is that there's a lot of market volatility right now, and stocks like this tend to get hammered pretty bad because investors look more for value and they focus more on fundamentals and profitability. So stocks like Shopify don't really tend to perform so well during these times of volatility. So I just feel that there's going to be better prices going forward, and so that's kind of what I'm waiting for. But I would definitely like to pick up Shopify in the future. And you guys can correct me if I'm wrong, but unless I'm reading their earnings report incorrectly, their balance sheet looks really good with very little debt at over $1.7 billion in current assets and total assets coming in at around $1.8 billion, while total liabilities is only at around $169 million. So while their assets may not be as high as some other companies, their current and total asset to liability ratios are very strong. And even with the drop in share price, this new public offering should probably raise a few $100 million more that will add to those current assets as well. Okay guys, next up here we have Johnson & Johnson. Now, Their stock dropped by over 10% today, and it's kind of a shame because they were actually seeing a pretty nice rally here at the second half of the year, as opposed to some of these other very popular stocks that have been performing very poorly lately. But they're still up 45% in the last 5 years, but they are now down over 5% year to date. Now, you've probably heard of them. They're essentially a giant corporation that is behind many household products like Listerine, Band-Aid, Benadryl. They're famous for their powders and lotions and cosmetic products. The list just really goes on and on, but they're also a major player in healthcare with medical research, services, and devices, along with a pharmaceutical segment that has seen a lot of growth. In fact, in their latest quarter, worldwide pharmaceutical sales increased by almost 7%, thanks to a number of different drugs that I shouldn't even bother trying to pronounce. Anyway, investors love Johnson & Johnson because it's a relatively safe company that owns many household brand names that usually performs well enough and isn't likely to disappear because consumers rely heavily on their products even during times of uncertainty in the economy. And just as big of a reason is because of their dividends. Now, their yield is not currently very high at only around 2.4% according to Seeking Alpha, but their payout ratio is healthy at less than 50%, and they have one of the biggest dividend growth histories in the world at 56 straight years of growing those dividends every single year. So for any retiree or dividend income investor, J&J offers one of the most reliable sources of income out there in their dividends. So what happened today to send the stock plummeting by over 10%? Well, J&J has been dealing with lawsuits that their talc products like their baby powder causes cancer to certain people, and now a report from Reuters is saying that from 1971 to the early 2000s, their raw talc and finished baby powders sometimes tested positive for small amounts of asbestos, which is known to cause cancer. They also claim to show evidence that J&J tried to influence US regulators' plans to limit asbestos in cosmetic talc products and scientific research on the health effects of talc. However, J&J claims that the Reuters article is one-sided, false, and inflammatory, and claims that their baby powder is safe and asbestos-free. In any case, J&J is currently facing many lawsuits for its talc products. Now, CNBC released an article shortly after saying that J&J is a company of the highest integrity that puts the interests of its customers first, and that the sell-off by investors is an overreaction. They claim that the Reuters article cites a Missouri court of 22 women who claimed the baby powder caused them to develop ovarian cancer, but it's a narrow set of information based on a group of plaintiff attorneys pursuing 9,000 additional cases against the company, and that the Reuters report ignores a similar case in California where J&J was found innocent, and an FDA statement that says a study found no asbestos fibers or structures in any of the samples of cosmetic-grade raw material talc. In any case, CNBC claims that it would be highly improbable to be able to show a link between baby powder and ovarian cancer. Needless to say, Johnson & Johnson is going to be taking a massive PR hit right now. It's being reflected in their stock, and this is also coming at a time when, again, there's a lot of market volatility. It's not a very good time to be taking a really big PR hit, so I'll probably be staying on the sidelines for this one. However, Johnson & Johnson is definitely a stock that I've always tracked because so many people are invested in them. But as you guys know, I consider myself a little bit more of a growth investor, a dividend growth investor, not so much of an income or value investor. And when looking at the growth for Johnson & Johnson, in their last quarter, they only grew revenue by 3.6%, which isn't bad, but it doesn't really fit my strategy. And even as a dividend growth investor, their 5-year growth rate is less than 7%, so it's a little low for me. So how do you guys feel about all this? Is this something that affects your view of Johnson & Johnson? Are you invested in them? Were you planning to and maybe now you won't? Or do you think that this is all an overreaction? Do you think this is something that we eventually forget about and the stock recovers? I don't know. I'd love to hear your thoughts on this. You know, a lot of people argue about whether you should let your personal feelings affect your investing decisions as well. I'm more on the side of things where, you know, I think that there's a lot of really good companies out there to invest in. So if you're not comfortable with what a company is doing, I don't feel like you have to invest in that company just because there's opportunity there. I think you can find opportunity elsewhere too. But that's just kind of in the broad sense. I'm not saying that that necessarily applies in this situation, because Johnson & Johnson is definitely taking a PR hit, and that will cut into your profits, at least in the short term. But again, if this is an overreaction, then maybe it's a buying opportunity. I don't know, there's a lot of different ways you could look at this, and not just from a strategic investing point of view, but also from a personal kind of moral and your personal beliefs point of view as well. So I'd love to hear all about it. Let me know in the comment section how you feel about this. I hope you guys enjoyed the video, and I'll catch you guys in the next one. Make sure you support the channel, hit the like button if it's not too much to ask, but thank you for watching. I'll see you guys later. Take care. Bye-bye.